All right, it is 1:30, so good afternoon, everyone. Bonjour tout le monde. My name is Alain Corriveau, and I'm a volunteer with the National Association of Federal Retirees, Ottawa Branch. I would like to begin by acknowledging that the land on which the National Association of Federal Retirees, Ottawa Branch office is located is traditional unceded territory of the Algonquin Anishinaabe people. On behalf of the Ottawa Branch, I'm pleased to welcome you to today's webinar entitled Climate Friendly Investing, Putting Your Money Where It Can Fight Climate Change. The webinar is brought to us by Climate Legacy and the Group of 78. Climate Legacy was founded by a group of seniors to engage and mobilize older Canadians in climate action through their voice, their time, and their money. Climate Legacy is a project of the Group of 78, which is an informal association of Canadians seeking to promote global priorities for peace and disarmament, equitable and sustainable development, and a strong and revitalized United Nations system. The Group of 78 recently held its annual conference on adaptation, building resilience in the climate emergency. The video recording of the conference can be viewed on the Group of 78 website. We thank Betty Pluis for the Climate Legacy Steering Committee, and Roy Culpepper, board chair of the Group of 78, and all their team members for their dedication, enthusiasm in bringing this webinar to you. Veuillez noter que le webinaire sera présenté en anglais, mais la participation bilingue est toujours encouragée. Also, please note that this webinar will not provide investment advice regarding specific investments, and Ottawa Branch takes no responsibility for any investment decisions that participants may make. The information presented in the webinar is that of the presenters and should not be interpreted as being the position of the NAFR Ottawa Branch. I want to give a special welcome to anybody here who is not yet a member of the association. We hope these webinars will inspire you to join us. Just a reminder to everyone that the webinar is being recorded, but participants are not on the recording, only the presenters. There will be a 20-minute question and answer period at the end of the webinar, and that's where you have the opportunity to ask your questions through the chat box. Please write them in the chat box throughout the session, and I will read them to the presenters for their response. Now I'm going to turn over the presentation to our speakers for this afternoon. Our first speaker will be Mary Sue Talbot. Mary Sue is a partner and portfolio manager with Genesis Capital Management, and they focus on innovative investment solutions for institutions and families. Then we will hear from Tim Nash, founder of Good Investing and Investment Planning, an investment planning firm with a focus on sustainable investing. Tim is an expert in the matter, of course, and he also writes a bi-weekly column for the Toronto Star, and he's regularly featured in media publication. So thank you very much again to our presenters. Thank you to the Group of 78 and to Climate Legacy for presenting today's webinar. And I'll turn it over to Sue May Talbot.
Thank you. Hi, everyone. I'm glad to be joining you today. And thank you to the NAFR, Climate Legacy, and the Group of 78 for inviting me to speak today. So I'm going to share my screen now and bring up my presentation. And sorry, there is a lot going on my screen. Just going to full screen mode here. Okay, great. So as a portfolio manager, I work with responsible investors who want to make a positive difference with their capital. And today we're going to talk about climate-friendly investing and using your investments as a tool against the climate crisis. And we'll discover that we can significantly reduce our carbon footprint by cleaning up our portfolios. And we'll also discuss the other benefits of responsible investing beyond just climate action. So let's get started. What is driving the divestment movement? Well, here may be one of the reasons. We are seeing a relentless rise of carbon dioxide in the atmosphere. And you can see over hundreds of thousands of years, the carbon dioxide level has not gone over 300 parts per million. But in 1950, it bypassed that. And ever since, it's been growing. And right now we are at about 400 to 430 parts per million. And a lot of people connect this to climate change, and they want to divest from fossil fuels. Climate change is one of the main reasons why people want to invest more responsibly. And that's why investors look at ESG factors when making their investment decisions. So ESG stands for environmental, social, and governance. And these factors or considerations are the main drivers behind responsible investing. So let's take a closer look at them. No surprise, a lot of investors are focused on the E, or on the environmental factors. Climate change is one of our biggest challenges, so that makes a lot of sense. So there's been a lot of focus on climate change and pollution. However, there has been a shift during the past year and a half to the S&G, or the social and governance factors. We've been dealing with a global pandemic, and that has devastated both the economy and society. And it's really created this perfect storm of environmental, social, and governance issues. And it's also highlighted racial injustice and social and economic inequality in our societies and our workplaces. We can't forget the George Floyd and Black Lives Matter protests from summer of 2020. And these protests just didn't happen in the US, they spread globally as well. So upon reflection and reassessing their values, investors want to be on the right side of change and not on the wrong side of it. So what are some of the S&G considerations for investors? Examples of social considerations may be looking at worker safety and the impact on local communities. Governance considerations may be looking at the diversity of board members, both gender and ethnic, and things like executive compensation and business ethics as well. ESG considerations have always been important for responsible investors, but they have certainly been highlighted during this past year. For the most part, investors want to divest for values reasons or for values alignment. So when you invest in a company, you are essentially financing that company. So if you want to be a strong proponent in climate action, you shouldn't be owning a fossil fuel company or other harmful products and services that you don't agree with. So investors may divest for values reasons. But many investors also divest for financial reasons as well, and that's so they can avoid investment risk. Products that are more likely to hurt people or the environment are open to more risks, such as cultural backlash, taxes, regulation, and litigation. And we've already seen this happen with tobacco, and of course, we're starting to see this happen with fossil fuels as well. So less demand for products and services will eventually hit the company stock price. So that's not a viable business model to have, to produce harmful products or services. So in this case, you are divesting for financial reasons. Here's another reason to avoid fossil fuels, and that is something that is referred to as stranded asset risk. If we were to burn all the fossil fuels currently on companies' balance sheets, we would be unable to meet our climate goals, such as the Paris Agreement and others. Therefore, it's likely that many of these assets will be unused and left stranded. So what this means is they will not be burned. They will remain stranded in the ground and worthless. And you can see them listed here. 49% of gas reserves, 33% of oil reserves, and a staggering 82% of coal reserves. So let's talk a little bit more about stranded assets. So stranded assets are defined as those that lose value or turn into liabilities before the end of their expected economic life. So we talked about environmental regulation causing stranded assets, but there are also other risks as well. There is the economics, or the cost of production. So if you are producing a product at a loss, why bother doing it? In 2008, oil peaked at $124. And since about 2015, oil has hovered around the $60 to $80 range. So it's become less profitable for some countries to produce. And some oil types, such as oil sands, cost about $80 US to break even. And in April of 2020, we saw oil reach a low of about $19 as demand for oil and gas fell off a cliff during the pandemic. So even now, with demand increasing, oil has rebounded to just about $80 to about $83 the last time I checked. So the economics, or the cost of production, should also be a consideration. Then there's innovation. We've had energy efficiency gains, and alternative and renewable energy costs have come down. The trend of cheaper renewables contrasts with oil, where harder to access reserves or more costly to develop, such as oil sands. Onshore wind is already competitive with fossil fuels in some regions. So there's also been advancements in battery technology as well. So stranded asset risk is more than just about unburned fossil fuels. So what about performance? Well, I'm sure we've all heard the argument and misconception that you have to give up returns in order to invest responsibly. But if you actually looked at the past performance of responsible investment funds, you'll see that you don't need to choose between returns and values. You can have both. And so the next slides I'm going to show you will show the performance of responsible investment funds versus all other funds in the same asset class. And we'll start with Canadian equities. So the blue bars represent the average responsible investment fund returns, and the gray bars represent the average fund. So you can see for 1, 3, and 5 years, the average return of the responsible investment funds either matched or exceeded those of the average fund. And the same story for global equities. The responsible investment funds matched or exceeded those of all the average funds. And these are the returns for global balanced funds. They slightly underperformed for the 1 year, but exceeded for 3 and 5 years. So I think these reports show that responsible funds have performed well, both over the short and long term, and that you don't have to sacrifice performance in order to invest responsibly. So far, we've discussed the key benefits of responsible investing. You want to contribute positively to society. You don't want to harm the environment or contribute to climate change. So that's the values perspective. There's also enhancing long-term performance. High carbon industries and other companies that hurt the people or the environment are open to big risks, such as litigation, regulation, cultural backlash, and taxes. There's also stranded asset risk. So that's the financial perspective. What we haven't talked about yet is improving risk management. So when you consider ESG factors in your financial analysis, it can highlight risks that investors may not have considered and may not be visible on companies' balance sheets. So I'll share a few examples with you. There's the BP deepwater oil rig explosion in 2010. And this caused the largest oil spill ever recorded in US waters. And BP shares plummeted by 55%. But how could investors have foreseen this? Well, in the 3 years leading up to the explosion, BP was cited for a staggering 760 safety violations, and the next highest violator only had 8. So there were certainly red flags and warning signs, but you had to look into the health and safety record to be able to see that risk. And worker safety falls under social considerations. And in the case of an insurance company, you may factor in changing weather patterns due to climate change if that increased the risk of owning the stock. So extreme weather will result in damages to homes and businesses. And of course, this results into more insurance claims. So this is an example of an environmental risk. And what about poor ethics? In the case of Wells Fargo. So we all heard about the 2016 fake account scandal. So this is where they opened up millions of fraudulent accounts for clients without their consent. And the stock price dropped 20% on the news. Wells Fargo was one of America's most valuable banks, but now it's trailing its peers. So poor ethics is a governance issue. So when you consider ESG factors in your financial analysis, it can highlight risks that investors may not have considered. So this is a third benefit. So let's have a look at the growth of responsible investments. And these stats are according to a 2020 Responsible Investment Association Trends Report. So in Canada, we have $3.2 trillion of responsible investments under management. And for the first time ever, responsible investments accounted for over half of the assets in Canada at almost 62%. And we've seen a 48% growth in responsible assets over a 2-year period. And back to performance. As of June 30th, 2021, 70% of Canadian responsible investment funds outperformed the average asset class returns over the previous 3 years. And what about the future and growth of responsible investments? Interest in responsible investments remain high, and you can see in this survey by the Responsible Investments Association, a large majority of respondents at 73% were very interested or somewhat interested. And from a demographic standpoint, I think this data is really important to note. 50% of the 18 to 34 age group reported that they currently own responsible investments, compared to 31% ages 35 to 54, and only 20% 55 and older. Therefore, responsible investments will become more important as the younger generations age, plus the wealth held by the older generation will be passed down. So this implies that So I'm just going to spend 30 seconds telling you a little bit about Genis. So Genis has been managing socially responsible investments for over 20 years, and we have an entire suite of fossil-free and broadly sustainable funds that not only divest from fossil fuels, but other harmful products and services, such as military contracting, weapons, factory farming, junk food, and others. We also have an impact equity and impact bond fund. So impact investing goes one step further than just divesting. It actively seeks out companies that are making a positive difference both environmentally and socially. And companies held in this strategy would be involved in things like alternative and clean energy, clean water solutions, and access to technology and education as examples. And I believe these slides will be shared later, so feel free to look at this other information when you have a chance. And I'm running out of time, so I will just end it here. So to summarize, through our investments, we can really make a difference when it comes to climate action and making a positive contribution to society. We can lower our overall carbon footprint and the carbon intensity of our portfolios. And we've seen studies that show you can make a positive impact and invest responsibly, and you don't have to sacrifice returns. Thank you, everyone.
Thank you very much, Sumi. We will now go on with Tim's presentation, and we will have the question and answer period following Tim's presentation. Just to remind you, please write your questions in the chat box. Thank you, Tim, and over to you.
Okay, perfect. Can everybody hear me and see my slides? Yes, I'm getting some notes. Okay, great. Thank you so much to the organizers for inviting me to speak. And thank you everyone who's attending. Really grateful that you would decide to spend part of your morning or afternoon, depending on your time zone, joining us for this wonderful conversation. So I've got a little presentation about this idea of climate-friendly investing. Before I jump into it, I'll just share that, I've been in the space for over a decade now. I grew up in London, Ontario with my dad in the investment industry. So I grew up around stocks and bonds. I studied economics and philosophy as my undergrad, and obviously had a lot of questions about our economic system. So I went to Sweden, where I did my master's in sustainability. That's where I really learned about this concept of sustainable investing. I did my thesis on the subject, graduated in July of 2008, coming back to Canada to sort of take the investment world by storm. Obviously, my timing was great there because 2 months later, the stock market crashed. And really, sustainability got thrown on the back burner, back in 2008. So that's when I started my first business. I've been at it ever since. And really in the last few years, I've just seen interest grow in this tremendously. My business has taken off. The opportunities that are coming my way, just in terms of media and speaking to these issues, it's just been absolutely incredible. And especially since the COVID crash last year, when we saw the stock market fall, really in the recovery there, sustainable investing is now front and center when we talk about the economic recovery. So I'm just so excited about the momentum and being able to sort of have this avenue to be able to share my thoughts with all of you. Before I jump into the investment stuff, I have lots of pie charts that I'm going to show you, but I'm actually going to start you off with a cake chart. I sort of threw this slide in last minute because I think it's really helpful context to understand big picture what it is that we're talking about. This is a cake chart from a hero of mine. Her name is Hazel Henderson. She's been an absolute leader in this space of building a more sustainable economy. You can see this was a model from 1982. So, really the idea here is that the economy is a lot broader than what we actually talk about in the media, that really without Mother Nature, without that bottom layer, that sort of rich soil, dark chocolate layer, there wouldn't be an economy without nature. So we depend on nature for absolutely everything. From there, you can see the love economy. And this is going to be things like volunteering. This is going to be things like family looking after each other, right? A lot of this unpaid labor that takes place in our economy, this doesn't get counted in our economic measures. But again, without that love economy, without, us looking after each other, we wouldn't have an economy at all. From there, we do have the underground economy, sort of the black market there. That's kind of, we don't measure that. That doesn't get counted. And that really, when it comes to this idea of the monetized part of the economy that counts towards, it used to be GNP, gross national product. Now we talk about GDP, gross domestic product. Really it's about this public sector and the private sector. Obviously the public sector, without our education and our healthcare and transit and roads, none of this would exist. And then really what we're focusing on right now is just this topmost layer, that private sector layer of the economy, the sort of very, very sweet, very saccharine, sugar-filled private sector. This is the stock market. This is where most of the profits are made. This is really what we're talking about today. But I do want to be clear that really without all of these other layers of the economy, we wouldn't have a stock market that is able to generate as much wealth as we do. So, now that we understand sort of that broader picture, now we can talk about investment theory. And so when it comes to a traditional investment portfolio, this is just a very boring pie chart. This is a mix of both stocks and bonds. So very important to have that diversification in your portfolio. This is a mix, sort of a normal mix of 60% stocks, 40% bonds. I recognize most of the people in this audience are a little bit older, or probably, in retirement or approaching retirement. You should probably have more bonds than this in your portfolio, but that would be work that you would do with your financial advisor. From there, with our stocks, we want to make sure that we are diversified between Canadian, US, and international stocks. But really the problem here is that, when it comes to these traditional investment portfolios, and if you just answered the phone, I think we can hear you. If you wouldn't mind muting, if you just answered your phone,
that would be fine.
Appreciate that.
Bye-bye.
And you've probably got me muted, but that's okay. So when it comes to this traditional investment portfolio, the problem is that if we're not doing responsible investments, then there's going to be stuff in here that you probably don't want. That if you haven't gone out of your way to invest responsibly, there are going to be companies like Exxon or Philip Morris, which is tobacco, Lockheed Martin, which is weapons, TC Energy, that's TransCanada, which is pipelines, or Barrick Gold, which has done some truly atrocious things in their gold mines around the world. So, these companies by default are going to be inside of your portfolio. Right? This is just the normal way, unless you decide to do something a little bit different, unless you have these conversations with your advisor. From a climate perspective, really what I want to highlight is just how dirty a traditional portfolio really is. So this is a study that was done in 2018, looking at the carbon footprint. This is an annual carbon footprint of investment portfolios. And, most of us that care about climate change, we've taken actions. Like maybe we're not flying as much, maybe we bought an electric car, or, we're riding our bike as much as we can. A lot of us are eating less meat. And those are wonderful things for us to be doing. I absolutely want to be clear. We need to be doing those things. However, if you've taken those actions, but you have not looked at the carbon footprint of your investment portfolio, you are missing probably the biggest piece of your personal carbon footprint. That even, 100K or 500K portfolio, right, is an annual carbon footprint basis is, bigger than all of those other actions put together. So this is what I really want to reinforce, is that if you care about climate change and your personal carbon footprint, you need to be looking at your investment portfolio. And specifically, since, many of you are at the, in retirement or close towards retirement, it's possible that your portfolio is $1 million or more than that. I mean, to retire and have a good retirement in Canada, you often need more than $1 million, and you can just see the annual impact of that portfolio. So, really, when it comes back to this traditional portfolio, I want to be clear that we're not, what Sume and I are talking about, we're not, reinventing the wheel here. All we're doing is making a very slight change from this traditional portfolio to a more sustainable portfolio. Now, we're still going to have a mix of stocks and bonds, and we're still going to want global diversification. However, what I talk about is that we want to split it up between what I call doing less evil with your stocks and bonds, and I'll speak to what that means. And then as well, the doing more good side, where maybe we want to have a little bit of green stocks in our portfolio. Maybe we want to have some of these impact bonds in our portfolio. I'm going to talk about each of these slices quickly, just a quick overview to kind of share what I mean by this sort of doing less evil and doing more good approach. But I want to be clear that this is a very similar, when Sume showed the performance, it was really similar, a responsible portfolio versus a non-responsible. And that's because it's not actually that much different. When before I jump into that, I do just want to touch on this momentum that Sume had talked about with the assets under management. And really what I want to highlight here is the sort of how sustainable investing is now on the front burner since the COVID crash. So now these are sustainable fund assets. So this isn't like growth of the performance of the portfolio. This is the amount of dollars flowing into sustainable funds. And it was pretty, standard. We saw a little bit of growth over the last few years. This was the crash, right, when the whole stock market fell in early 2020, right? So all assets would fall there. But then since then, oh my goodness, the interest that we've seen in sustainable investing, it has just popped. And that now what's different from 2008 is that this conversation is now front and center, right? Which to me is so exciting. Now, when it comes to this approach of doing less evil, there are a few different approaches that we can use. The negative screens, this is what Sumay talked about with divestment, where you just say, nope, thumbs down. I don't want to own one penny in whatever it is. Everyone's going to have a different place to draw the line. Most people, they want to get rid of things like tobacco and weapons. Here, when we talk about divestment from fossil fuels, that's going to be oil and coal and natural gas. It might be pipelines. It might not be. Everyone's going to have a different definition of what that means. Now, that's kind of the most, I don't want to say extreme route, but that I would say is sort of the biggest action that you can take. The other two are a little bit less. This idea of ESG, environmental social governance, this is where we might still be okay with some oil companies. We just want to get rid of the worst ones. Right. So this is where we can get that ESG score. We can see, within a sector, which ones are the leaders, which ones are the laggards, and maybe we'll tilt things more towards the leaders, From there, the last piece is shareholder activism. And this is, hey, if you don't want to do anything else, if you just want to have a standard investment portfolio, that's just fine and dandy. But recognize that by owning shares in those companies, hey, you get a voice. And that your fund manager, whoever is, managing this for you, whatever funds you own, they get to use your voice, and we can use that voice to push companies in a more sustainable direction. So, when we look at a company like Exxon, negative screening would be saying, no, not one penny. I don't want one penny going towards invested in Exxon. ESG would be to say, okay, well, let's look at Exxon's ESG score. And if they have a bad score, maybe we'll have a little bit less. Right? Or maybe they don't quite make the cut there. Maybe we'll invest in oil companies that are a little bit leaders. And then shareholder activism would say, you know what? I'm going to own shares of Exxon, but I'm going to push Exxon in a more sustainable direction, which we actually saw a lot of movement from them this year, where they had 3 new board members that got added that specialize in transition. I'm not saying that's the best thing, but hey, that's action, that's movement from Exxon that we hadn't seen in decades and decades. So these are the different approaches. I would say use all 3. These aren't, exclusionary. I want all of these approaches from my fund manager, but this is the language that we can use there. Now, the big issue is greenwashing. Right. And I think we're all really, really worried about greenwashing. ESG, or responsible investing, sustainable investing, this is a very hot topic. You've seen the fund flows. So there's a lot of marketing going into this right now. And we need to go through and make sure that, it actually lives up to the marketing. So I really want to be clear right now. There are a wide range of options, from a small step in the right direction all the way through to what I call like a crunchy granola portfolio, something that uses all of those measures. And don't trust the label, don't trust the brochures, don't trust the marketing. That you really need to look under the hood. You need to open it up and look inside and ask tough questions. And in the Q&A, we can arm you with questions if that would be helpful. But really, this is something where it is a bit of buyer beware, that you do need to understand, what it is that you're actually buying, because greenwashing is so prevalent right now. When it comes to green stocks, this is where, we can carve out part of your portfolio for these investment themes. We call these thematic investments. And these themes could be things like renewable energy, clean technology. The UN has the Sustainable Development Goals, the SDGs, which are a really cool framework for, investing in the solutions, this idea of doing more good. However, when we're investing in these sort of green stocks, they usually are more volatile, that they don't necessarily track the market in the same way that the doing less evil approach will. Here, we're kind of putting a bet on the emergence of the green economy. So these can be a little bit riskier. They usually are more volatile. So again, I don't want you to bet the farm on electric cars. I wouldn't want you to put all of your money into Tesla. Obviously, we want to be diversified. And when it comes to these green stocks, we want to be really deliberate about what percentage of our money that we do want to invest in these doing more good stocks. From there, the piece that I'm most excited about is this idea of impact bonds. That to me, this is just such a cool thing. This is outside of the stock market. Okay. So these aren't things that you're going to do through an advisor or through an online broker. You're making direct investments into nonprofits and co-ops within your community. So this is really like a direct positive impact. And, really what we want to do here is invest directly in these organizations that are having that positive impact. I do have research available. So if you want to go to my website, Aaron, I don't know if you can put this link in the chat, but this is a little research tool that I've put in. This is a list of these sort of retail impact investments. So I've got this on my website. You can just see and, hopefully find something that's local for you. Something like Earth Day Canada has this eco-charge bond where, you can earn between 3.5% to 4% per year, and you're helping them build out electric vehicle charging stations in Quebec and New Brunswick, which is super cool. So, feel free to take a look at that. Again, you wouldn't want to put all of your money into these things. You'd want to carve out part of your portfolio. From there, really, my final thoughts, and, happy to dig in deeper with the Q&A. If you've got questions, I'm sure you do, but really want to reinforce that there are more choices than ever before. That, when I started doing this 10, 12 years ago, divesting from fossil fuel was such a pain. And now there are products like Genesis, there are other products that are it's really easy to divest from fossil fuels, that the choices are there. But really, you do have to ask the tough questions. This isn't, something where you can trust the label. That I do want you to be intentional and really ask those tough questions. And the last thing is really to empower you, like put your money where your values are. That, this is something that a lot of people are doing right now, that a lot of people are doing this homework, doing this research, and actually taking the action of, shifting their assets. And it's having, in my mind, a pretty profound impact on the state of the economy, which to me is super exciting. So that's all I've got. I've got my contact info. If we're not able to get to your question, then, you can always reach out via email or send me a tweet if you're there, really whatever, but just know that I'm here and happy to answer all of your questions. Thanks so much.
All right. Thank you very much, Tim. Just a couple of comments before we go to the question and answer. I think we have to be careful about the hyperbole in language. Talking about evil investments, that may be a nice term, but maybe something that we can stay away from. Second thing is, Tim, you talked about tilting things towards the leaders. I wonder if you would care to comment about the recent announcement by the Caisse de dépôt et placement du Québec, where they say that they will withdraw from investing in oil production by the end of 2022 and will devote $10 billion envelope to decarbonize carbon-emitting industrial sector. Any thoughts on that?
Yeah, sure. I'm thrilled they're following my framework, right? That Caisse de dépôt is doing all three of those things. They are now divesting from fossil fuels, doing a negative screen. They've been doing ESG, and they've embedded that into their investment decision-making across the other sectors. And they're doing shareholder engagement in the remaining companies, pushing that towards sustainability. And what's really exciting to me is that they are getting rid of those, I can call them nasty or polluting companies, or, whatever language we are comfortable with there. And that what they are doing is carving out part of their portfolio for the solutions. That if our economy is going to be making this transition, in my mind, we do need to be doing both of those things, which is reducing our exposure to the laggards and then increasing our exposure to the leaders. So to me, it's like they're following the playbook here. And, they are the second largest pension fund in Canada behind CPP. So this is an absolutely massive vote of confidence. And what I would say is that the institutions, it's been pensions and foundations and what we call institutional investors, which is often what we refer to as the smart money, is doing this. And it's the individuals, it's the retail investors that are kind of behind the curve on this. So part of my fear is that, to Sumay's talk about the risk is that, you don't want to be left behind on these issues. This is definitely a situation where you want to skate to where the puck is headed. And it's clear that a lot of those big players are moving quickly in this direction.
Yeah, I think that's probably the sign of a paradigm shift when you have an organization such as the Caisse that's really making a public announcement, and a very strongly worded public announcement as well, with very clear goals and targets. On with the questions, and again, that's just to remind people that the intent is not to provide individual advice, but to provide information. So if some of the questions that I'm going to read are slightly slanted towards individual advice, we will handle them in a way that is more a general response. First one is, talking about ESG, who determines whether a company scores high or low in terms of ESG? Some energy companies and other companies claim to perform well in terms of ESG, but are there actual scoring criteria? So, Tim, do you want to address that one, or maybe Sue may?
Well, sure. I mean, we work with Sustainalytics that was recently bought by Morningstar, and they help us with our ESG measurements, and we also use MSCI World as well. So we engage with data providers to provide that information for us. We develop the framework on what we want to look at, and we give that framework to our providers, and then they in turn do the research for us and provide the scores for us as well.
What are some of the criteria that would be included in the framework?
Well, what we do is we look at percent of revenue, right? So, as Tim said, everybody's different in terms of, what they want to look at. And measuring it is, is really difficult. And so when you have, in our view anyways, when you have a disciplined approach, you can't really argue with it, because this is the approach that we take, and we stick with it. So we look at percent of revenue generated by the product or service. So anything that is above 10% of the revenue generated, it automatically gets screened out. So I think in that way, it also answers the greenwashing question as well, is when you look at percent of revenue, you can tell immediately the intent, right? If it's just kind of paying lip service to whatever it is, then that it's not going to make a big difference. And so at Janus, we look at percent of revenue to make that determination on the ESG factors, and also get information from our service providers as well.
Okay. All right. Thank you.
Can I add quickly?
Yes, go ahead, Tim.
I just posted 2 links in there, which are links to the free tools from Sustainalytics and MSCI, so that you can, punch in the company name. It's not going to be all of their company very high level scores, but you can wrap your head around it. All I would say is that it's very different. You need to understand the ESG scores. You can't compare companies from different sectors. Right? That really is a useful tool. I can look at 2 oil companies against each other, but if I'm comparing an oil company to a tech company, that ESG score is completely useless for doing that. Right? So this is why I say you want the negative screens. If you're saying no oil, then that's an exclusion. And that the ESG, that's going to be very different. That's going to be assessment of their policies and their goals and their performance, that, it really doesn't look as much about what they're actually selling. So yes, you can get oil companies or military companies or tobacco companies that have high ESG scores. And that's why, again, it's important to Sumay's point to look at where they're getting their revenue from, right? And having those negative screens in addition to that ESG score.
Right. And Tim, and you bring up a great point, is looking at the company's peers, to see where they stand against their peers, because obviously different, like you said, different sectors, different businesses, they would all score differently. So it's important to look at the company's peers to see where they stand.
Yeah, comparing good apples to good apples. Here we have a question from a DIY investor who for half a decade has been investing in sustainable ETFs and funds. The question is, what I want are actual investment ideas. Where can I find ideas for ETFs or funds I can purchase? So not actual
I'll handle
funds,
this one.
but ideas on where to find them.
I won't give out the ticker symbols, but go to my website, goodinvesting.com. I have a research tool. You can see I've broken it down, all-in-one ETFs, global equity, bond ETFs. I've got model portfolios up there to give people ideas. So goodinvesting.com/research is, that's the tool that I wish existed. It's the database I wish existed, and I built it.
Okay, and Suma, you also mentioned Morningstar, who has information that can help in that regards.
Yes, definitely.
Yeah. Next one is, can we do responsible investing with our regular investment companies or institutions?
I can handle this one, Sume, I think, just because, I'm probably a little more used to it. But yes, it depends on the institution. But largely, yes, it's now so commonplace that basically every firm should have some option. That said, remember what I talked about greenwashing. So, unfortunately, a lot of people, they gloss over a lot of these issues that you are going to want to look under the hood. My suggestion would be to open it up. That's always the first thing, is to speak to your existing advisor or investment provider to see what options they have and talk to them. But, be skeptical. Don't listen to the marketing materials. You want to have a list of the holdings. You want to get a sense of the methodology or the criteria that they're using, right? And then I'll be blunt that a lot of them don't go far enough, or they have a responsible option and the fees are way higher, that it's like buying organic food at the grocery store. And so, if you don't like the response that you're getting, I do think it's a good idea to shop around. That, a lot of, especially right now where I know, people are tightening their belts a little bit and looking at ways to be able to save money on different things. Very few people shop around when it comes to their investments. And I'm telling you, most people that I've dealt with, just by kind of, shopping around, you can find something that's probably a better fit, and you might even be able to save some money in management fees.
Yeah, and I just want to...
Yes, go ahead.
Sorry, I just wanted to add that, looking at somebody that has a longer term track record as well may be useful, because there's a lot of new, products and services out there, unproven at this point, right? Because they're brand new. And so, most people would have two goals: is, you want to align your portfolio with your values, but at the same time, you want to earn a decent rate of return as well. So, make sure that whatever you're looking at does have a track record for you to review, just to make sure that it can meet your financial goals as well.
Yeah, doing your homework is always important. Frequently, fossil fuel holdings are bundled in side packages, and investors are told that to break these up to remove the fossil fuel components will harm the whole. I'm not sure that there's a question in there, but maybe would you care to comment on that? We'll start with Tim and then Sue.
Sure, I'm happy. I think it was Susan that asked that. So that's bunk. I'll use a polite word there, but that's just simply whoever told you that is kind of not being fully honest with you. The way these things are bundled up, they are funds, so they are bundled together, and there are so many different ways of bundling those funds. Really, to me, that says that you've got a bit of a lazy advisor, that they either don't want to do the work of sort of unpackaging it, or that they don't have anything on their shelf that excludes those things. But to me, whoever told you this is an absolute red flag. It's not true at all.
I agree with Tim. It's not.
So what would be useful in those circumstances? Do you have examples somewhere of questions that someone could ask to really push the envelope?
Yeah. So first you need to understand the power dynamic, and, going into these conversations with an existing advisor, it's hard. And I recognize that. I've had clients that have brought this stuff up and they've been spoken down to or laughed at, especially for women, going in, there's a power dynamic here. We need to understand. You also need to understand that most people in the investment industry have a more conservative mindset. There's a self-selection bias here, where I've dealt with so many people in the investment industry who just don't think climate change is a problem, or who think that with sustainability or responsibility, you're sacrificing huge things. That's just wrong. That's coming from a place of ignorance. So understand that going into the conversation. Really what you want to do is you want to ask them, number one, what responsible investment options are available? What do you have on the shelf? Right? That's the number one question. They might have to get back to you because they might not know off the top of their head, but you want to know what's available. Number two is then, okay, great. I have these options. Thank you. What is the methodology that you're using? Remembering how I talked about the exclusions, the negative screens, right? The ESG and the shareholder engagement. I would want to see which of those and to what extent each of those. And then number three, this is to me the most important thing, is I want you to ask for a list of all the holdings, and not just the top 10. I want all of the holdings. And you'll be able to go through, and this is where it's a gut check, because there are going to be companies in there that you don't like. And this is where the rubber hits the road. And you have to decide, is it like a thumb sideways that like, I can hold my nose, something like, Coca-Cola or McDonald's. Maybe I don't love it, but okay, it's not, whatever. Or is it a thumbs down? Say not one, I do not want one penny. And that's going to be different for everyone. But to me, those are the three questions. What products are available? What's the methodology that this fund uses? And then I want a list of all three holdings. And with that, you should have information to determine whether it's greenwashing. If you open it up and ExxonMobil is still in there, that kind of tells you what you need to know, right?
Okay. So the next question or comment talks about questions to avoid greenwashing. I think you've given us three good ones there. Any more comments on that? No? Okay. So the next one is, I'm also interested in individual Canadian clean tech stocks, so I can get away from bundled funds. Again, we're not providing specific investment advice, but anything to comment or to add on where to get information? We've already mentioned things like Morningstar, for example.
Yeah. So I think I can handle this one just because, really. So first of all, I would caution you with individual clean tech. Again, these are volatile. So there's a reason I like funds. And I would urge you to look at funds that are thematic. You can get clean tech or sustainability funds now that will do this research for you. That said, if you really want to go there and you're kind of adamant doing that, I would look at some of these clean tech funds, sustainability funds. The Doing More Good ones that are listed on my website are a nice place to start. And you can look at the individual holdings within those ETFs, right? Because there's a button that says holdings and it'll give you the full list. And then you can then look at those individual companies, on your own. That said, I would just be really, really cautious here. The number of people I've seen just absolutely lose their shirt betting on, small cap Canadian, clean tech companies, that it's just really, to me, it's not worth it. I would be really cautious and, hire an expert for help with this. Or, the easier thing to do is just stay away from individual companies.
All right. Thank you. Yes, Sumi?
I was just going to say, I agree totally with Tim. When Biden got elected, I think everybody, kind of jumped on the bandwagon and, was anticipating, that clean energy, renewable energy would really benefit. But the opposite has happened. Yeah. If you look at, what clean tech has done, it's really, really underperformed during the past 6 months or so, or just over 6 months. So I agree totally with Tim is, you should probably look at some of these clean tech funds and get some professional advice on that.
Yes, my take on that is it's always good to get professional advice, reliable professional advice. You get what you pay for. So if you ask your cousin, you may not get very good advice.
I guess I better raise my fees there, Alain.
Pardon me?
I guess I better raise my fees there to get what you pay for it.
Well, I'm not saying that so that you would raise your fees, but what I'm saying is the value of good, sound, professional advice is not something that we should discount because you have to pay for it. And that's in all fields. And Tim, you mentioned your website address where people can get some additional information. It is in the chat box for those who want to get the address and go and look at the website and get some information. And then I think we have time for one more question. You mentioned Tesla. How can you justify Tesla being ESG when it uses a lot of energy to produce cars, but put people into space, and Elon Musk himself seems to get into a lot of SEC problems? That's a very vast question that I'll let you decide how much you want to comment on that.
Well, we look at ESG factors, right? So if you look at the governance factors with Tesla, yes, he did have issues, with the SEC. There was also issues with employee issues as well. I think he was being sued by some employees, for I can't remember what it was exactly. But anyways, he did have some issues, no doubt. And so at that point, we did not hold Tesla in our portfolios a few years ago because of those factors. Yes, he produces energy efficient vehicles. So his product is very high on the E factor, but very low on the S and the G factor. So for those reasons, we didn't own Tesla. And what we do is, you kind of think of it as putting him in the penalty box, or putting Tesla in the penalty box for a few years until he cleaned up his act. And he did clean up his act after a couple of years. And, there was less controversies. And at that point, we did put Tesla in our portfolios, but since for financial reasons, it's no longer in our portfolios. But, those are definitely considerations beyond the E of the ESG.
Great. And that just triggered in my mind something that people should keep in mind. It's ESG. There are 3 factors to consider.
Right.
Well, go ahead, Tim. You were going to.
Yeah, it's a bit of a pet peeve for me, the way the acronym ESG is used, because even just in the question, it assumes a binary response, that something is either ESG or it's not, right? And that's just absolutely the wrong way to think about ESG. Because ESG is an aggregate of all of these different factors. I think more than 300 key performance indicators that go into, ES and G, and then that gets combined into one score. So, really, it's not, it's not that something will be ESG or not. It's that Tesla has an ESG score compared to other auto manufacturers, and that they've lagged a lot of those companies on ESG metrics, specifically for the S and the G, and some real issues there. And again, this difference, ESG, is often referred to when we talk about green investing or these thematic funds, but these thematic funds often don't look at ESG scores at all. A number of the different clean tech or water funds, or in this case, electric vehicle funds, they're not looking at this ESG score. They're only trying to invest in that specific theme. So really, I just want to kind of push back on the mental model that you're using here and saying that it's not that something is either ESG or it's not. It's that ESG is an additional sort of a layer or a lens through which we can evaluate companies. And Tesla is a great example of the sort of murkiness in this space when it comes to ESG analysis. And then again, it's really going to be up to you. If you want it to be binary, like it either it is or it isn't, that's going to be up to every single individual person. And for some people, Tesla is going to be a thumbs down for, whatever ethical reasons. For other people, they're going to want exposure to this electric vehicle theme, and that's going to be a thumbs up, and they're going to want that. So, these are very individual things. And I just really, I want people to understand a little bit more of the nuance here. And we're trying to keep things high level, right? But it's really, really hard when something is binary, that it either is or it isn't. Ultimately, these things are going to come up to you and your specific preferences. And then it's going to come down to those research providers, MSCI and Sustainalytics, and they're not perfect. So it's going to come down to their methodology. And to me, really, I want to end off with this notion that we don't need a perfectly sustainable portfolio, right? That's not the goal here. That doesn't exist. Instead, what we're talking about is taking a big step in the right direction without sacrificing financial returns. And if you can just take a step in the right direction while still earning the returns and doing everything, that will have such a tremendous impact, both in terms of your personal footprint and your impact on the world, but also if everybody does that, that's going to have a huge impact on the broader economy.
All right. Thank you very much, Tim. Those are excellent points that you made there, and it gives me an excellent way to conclude the webinar so that we end on time. I would like to thank everyone who participated today, and especially thank Sue May Talbot and Tim Nash, and of course, Climate Legacy and the Group of 78. We can't forget also to thank our volunteers, Erin Higgins, who's our program coordinator, and without her, these things wouldn't happen. So thank you, Erin. Thank you to all of the volunteers who are part of making these webinars run. As I always say, we make the trains run on time because of the volunteers that participate and the people in our office. I also look forward to seeing some of you on the future webinars. Thank you, and have a good afternoon. Bye-bye.
Thank you, everyone.